Cindy on screen.
Hey, there we go. We connected to audio now.
There
Is
we
this
are.
Dion?
Nice to
Hi,
meet
Dion.
you.
Yeah, I've been seeing your name on my calendar for a minute. It's a pleasure to really meet you. And I appreciate you taking the time to be here tonight. I don't want to waste your time. Is there anyone else joining us? Or is it just us tonight?
Just us.
Okay.
It's me, myself, and I who got myself into all this debt.
Okay. All right. And is that generally the case or just for this meeting?
That is the case.
Okay, great. Awesome. Good to know. Let's get right into it. And the first thing I wanted to do before we really did anything else is I kind of want to just make sure this isn't a waste of your time, right?
Thank you.
And I don't think it is, but I want to ask a couple questions to make sure. First of all, you do have a mortgage or some other kind of debt, right?
I do. I have a mortgage, a car, and a credit card, and student loans from 1990.
Okay. Okay. And we're not even here tonight to get into any details on any of that stuff, but I just wanted to verify you did actually have something. Believe it or not, sometimes people show up here and they're like, oh, well, whatever. And then my other kind of qualifying question is just to verify that you do have some discretionary income and a desire and a willingness to use that discretionary income to get out of debt faster.
Yeah, if it's possible. I am on a shoestring budget month to month.
Well, that's kind of what I'm asking, but as long as you're positive, not negative, we can help you. So you are positive, not negative month to month generally?
I tote the line, that's for sure. Yeah.
Okay. And what do you do for a living?
I work for the Cheetah Conservation Fund as an event development manager.
So talk to me about that for a second. Is that actually like preserving cheetahs?
It is. It is. We're the world's largest organization in keeping the cheetah from extinction in the wild today.
Oh my God, you're breaking my heart. Like since I was a little boy, cheetahs were one of my favorite animals since I read about the fastest animal on land in the encyclopedia. They're close to extinction, really?
They're on the brink of it. We're worldwide. We're down to less than 7,100 cheetahs in the wild today.
That doesn't sound like very many. How many did there used to be?
Hundreds of thousands.
What's going on?
It's the illegal pet trade. So they're being trafficked for wealth, the loss of habitat. They are in a bottleneck. So there's no more genetic diversity. They're all related to each other for the most part. They're all from Arkansas. And then the human wildlife conflict. So the farmers in Namibia or Africa, they kill the cheetahs because they believe they're killing their livestock. So we go through a lot of education.
Is that even true?
No, it's usually a leopard or another predator, and the cheetah hunts during the day. They're one of the only animals that hunt during the day, and they're not nocturnal. So they get caught. The farmers catch them and assume that they were the ones who killed the livestock. And, losing a cow or sheep or any of their livestock for a farmer, it's detrimental to their livelihood. So,
of course, right.
Yep. Yeah.
Sounds similar to wolves in North America.
It's very similar. Yeah, they go hand in hand.
Mm-hmm. Mm-hmm. Two of my favorite animals. Breaks my heart. Sad.
Yeah.
Well, hats off to you for helping them, and that's pretty awesome. So it sounds like you have steady employment, and then it's just a matter of what expenses come up from month to month.
Bingo. And
right.
it's an NGO, so we're paid monthly.
Right. Okay. Mm-hmm. Okay. Well, I don't think we're wasting our time here. All right. So let's go ahead and get right into it. I did want to kind of properly take a second to introduce myself. I'm assuming you're on LinkedIn. And the first thing I want to do is invite you, if you care to connect with me on LinkedIn.
Okay.
And secondly, to look me up. I'm the only Christian McFarland that I'm aware of who's affiliated with this company. We're here to talk about United Financial Freedom. I'm definitely the only executive director by that name. There are quite a few executive directors, but no others with my name. And so the only reason I'm showing this to you for a second is I do have some articles about what we're here to talk about, including this article here about how I hired a debt terminator to save my family from the banksters. So if you cared to, you could go back and check out that little article, although that's kind of what I'm going to be telling you about in the next few minutes here. And then, of course, the rest of my resume is on there. To transition right now, the little backstory I wanted to kind of get into is that my background is as a financial advisor, and I have a couple of decades of experience doing that. I've only been doing this debt program for about 2.5 years.
Okay.
So I was living in California about 4 years ago when my dad passed away, pretty close to debt free, a little bit of consumer credit card debt, but my wife and I were out there. And when my dad passed away, this house that I'm sitting in here in Colorado right now, we were, afraid that on my mom's single Social Security, that we were almost certain that she was going to lose the house. So my wife and I made a decision to move back here. And I went from being pretty close to debt free to having $250,000 of mortgage. And I guess all I'm trying to say is at that time I was creeping up on 50 years old. And it felt like it was going to take me forever to pay off the 17 and a half years that was left on that
Yep.
mortgage. So I was just going to ask you, but you already answered me. And it sounds like you felt that way too.
Mm-hmm.
So I was walking around just kind of feeling that way for a while. And when I kind of found this program, initially I was introduced to it by my boss. And so I kind of had a little bit of a bad attitude at first. I was like, well, what's this new thing? And how much is this going to cost me and everything, to be completely honest, right? Pardon me, got a little frog in my throat there. That's better. All right. So all choked up about the cheetahs and wolves.
What part of Colorado are you in, Chris?
Buena Vista, Central Colorado, at the headwaters of the Arkansas River.
Okay. Okay. I'm in Pueblo West, so we're not too far.
What?
Yeah.
Really?
Yep.
Wow. Okay. I had no idea I was even talking to someone in Colorado. I'm from Pueblo. I mean, at least until I was about 10 years old, from 2 years old to 10 years old, I was living in Pueblo, and we lived on the west side too, on like 14th and Central. Am I saying that right? I think.
That's amazing. That's amazing.
Yeah.
I'm all the way out kind of near the reservoir.
Oh, wow. Okay. Oh yeah. Pueblo West. Oh yeah. Way. I'm talking about like West Pueblo, which is, yeah, totally different than Pueblo West.
Yep.
Right. We lived, in West Pueblo, there's that one middle school that's sort of by a butte and a cliff,
Yep.
and there's a television station up there.
Okay.
Yeah, we live like biking distance. I used to go up there with my childhood buddies and throw around the football and nonsense like that.
Small world. Very small
Yeah.
world.
And then we moved up to Denver, and I finished high school there, and then kind of got to California, and geez, by now, my whole bio. So I was, I was mostly in California, all in between there. And now I'm back in Colorado. And I guess that brings us back to the story here. So picking back up there, about 2.5 years ago, I joined this company, and I've been promoted with them 5 times since I joined, just because I've been lucky enough to help people get 12.5 million of debt under management. And in only 2 years, just little old me, I've helped people to pay off over $500,000, which is not bad, right? I'm not looking for any props or ego stroke or anything, but it's not bad, and I'm grateful that I did that work. But the company has saved $2.3 billion over the last 17 years for people. Now,
Wow.
that's a really big deal. That's 75,000 households. So let's jump right into the education here. The company, as I mentioned before, is called United Financial Freedom. And if you read their ebook or you do a little digging on Google or whatever, you'll also find out that they previously had 2 other names. Same company, same product. It's sort of weird that they have 3 names. They were originally United First Financial. Now, as I'm going to explain here, the company's been around since 2004, and they won this hoity-toity award called the Ernst & Young Entrepreneur of the Year Award in 2008. Now, in 2008, they also had this thing called the financial crisis. I don't know if you were in the stock market or you owned any real estate or had any experience with that. Okay. So nobody could get any kind of lines of credit for anything. Like nobody, even rich people or anything. It was called in history books the credit crisis. So this company from 2004 to 2008, the program only worked if people had a line of credit. And so they used to work with banks like Bank of America or Wells Fargo. And the banks loved them because they would send people over like, hey, you want to do this program? You got to go get a home equity line of credit and then come back and talk to us, right? And so it was actually Wells Fargo that nominated them for this award. But in 2008, when everything went crazy, the company almost went out of business because they had to reinvent themselves. Because at that point,
Wow.
nobody could get a line of credit, right?
Yep. Yep.
Now, two of the original owners were willing to dig into their own pockets to keep the company going, and two of them walked away. At that point, legally, they had to rename the company. Does that make sense?
Yep.
So for some reason, I'll never know, they came up with this, in my opinion, stupid name Worth Unlimited. You know who joined that company and bought the product from Worth Unlimited? That's right, me. I bought the product I'm going to show you a little bit later from Worth Unlimited, and I joined that company. Right after I joined, I'm grateful that they decided to go back to this logo, and they wanted it to sound similar to their original name. So they sort of rebranded to United Financial Freedom, which personally I think sounds way cooler than Worth Unlimited, right? Which,
Yep. Yep. Yep.
right. So
Unless you're
anyhow,
Tony Robbins.
yeah, right. Yeah, you're right. You nailed it. It is sort of like a like Tony Robbins thing. Like it's too woo, right? It's
Yeah.
too woo. So anyhow, that's why there have been three names. That part's kind of boring, and I sometimes skip that, but I just felt like getting into that tonight for some reason. So I don't know if you've ever thought about being a real estate investor besides the property you currently own. Just with a yes or no, has that ever crossed your mind?
It has. It has.
Okay. So you don't have to want to be a real estate investor, but you'll like it even more if you do. So kind of what we've revolutionized is to mention another name. You mentioned Tony Robbins. Another name a lot of people have heard of is Dave Ramsey.
Yep.
Okay. And so what I'm about to show you here is and I'm going to tell you when I transition to really what our program does, because we are very different than Dave Ramsey in some important ways, mostly in being less expensive, more modern, and easier to use. Okay.
Okay.
But fundamentally, in terms of the math and the idea and the concept, we're teaching the same thing that Dave Ramsey does. Okay. So for the next maybe 3 to 5 minutes, you may have well as just walked into a Dave Ramsey seminar.
Okay.
Except I'm Chris McFarland, not Dave. No, I'm just kidding. All right. So the first thing we're going to talk about here is a closed-end loan. So from the ones you mentioned, this would be your student loan, car loan, mortgage. On any kind of those closed-end loans, you do have to, as you know, make your minimum payment. And even if you make a prepayment, you still have to make that minimum payment. You can only make payments in, you can't take withdrawals. You really can't. People might say, oh, well, I can do a refi, but a refi is actually killing your current mortgage and getting a new one.
Yep.
That's literally what's restarting the clock. So within your current mortgage, you can only pay money into it. You can't take money out of it. And it's on an amortization schedule. Since that hurts my face a little bit every time I have to say that, I also call that the bank's plan. Okay. And so you can guess who the bank's plan is good for. The bank, right?
Yeah.
So I'm sure we can agree that if you sent in any extra money, that it would get you out of debt faster as long as it was credited to your principal. An
Mhm.
obvious illustration of that is say, like, just crazy example, but you won the Colorado lottery, you pay off your house, you're not going to have to pay any more interest on it, obviously. Kind of an obvious thing, right?
Right. Right.
So it should make sense then that if we send in any extra money, it's going to make some difference. It's just not going to get it all paid off at once. However, this is not what we suggest you do, is just like firing off extra money, because especially if you're on a tight budget, hello,
Mm-hmm.
and if you just started firing off every little extra penny and then things were a little bit tight next month, you could get in a fix, right? So we're not suggesting that you start doing that. In fact, the first thing we'd have you do is build up your cash reserves. I'm getting ahead of myself. So topic number 2 here is there's what you borrowed, and then there's what you actually owe, and they're not the same number at all.
Right.
So in this example here, if we borrowed 200,000, we're going to end up paying a lot more. without getting, all sidetracked on the boring math there. And it's going to change depending on the numbers. Now, this one's at 6%, which is a lot more like a student loan or a car loan than a house note.
Yeah.
Okay. But it really doesn't matter whether it's at 6 or 3 or even 2.5. It makes a little bit of difference, but not nearly as much as you might think, as I'm going to illustrate here in the next minute or two. So on that mortgage that we just looked at, or it's still an amortization schedule, depending on the length of the loan would be the only difference, whether it's a student loan, which are often on 30-year schedules as well. So when you make a payment at quote 6%, now, Dion, I was a literature major in college. Okay. I wasn't a math major, but I'm pretty sure that 6 isn't very close to 83, is it?
Nope.
Not really very close. Okay. So I honestly, this is a rhetorical question. I don't know how they get away with that, but what's called a 6% loan, you're paying 83%. And even if we go 5 years down, if you look on this interest column, 931.88, that's not a whole lot different than 1,000. It's common sense. You don't have to be a math major, right? I pulled out my calculator one day and I did the math at 77.7% is still going to interest on a quote 6% loan 5 years into it.
Amazing.
This explains why in this example we've paid almost 72, but our equity is only 14 because 58's gone to interest. So if we roll this all the way forward, even 21 years into it, we've paid 300,000 over here on the far column, mind you, on a $200,000 loan, but we still owe 100,000. Wait, let me get this straight. Like I said, I wasn't a math major, but we've paid 3 on 2 and we still owe 1. Is that the new math that teaching kids in school? Thank you for laughing. That's my little joke. But it's actually the old math that the banks have been doing forever in reality. Okay.
Yep.
So the next thing I'm going to show you, this is 4%. And at 4%, if I roll this all the way forward to year 15, we can see that we're paying 46 cents on the dollar on an air quotes 4% AM schedule. So there's got to be a better way. And we already hinted at it, which is making a prepayment. But the question is when it's comfortable and when we can afford to make a prepayment.
Yep. Yeah.
And so now I'm starting to get to what our program does and what makes us different than Dave Ramsey. But the basic concept of what we're talking about is exactly the same as Dave Ramsey, or he didn't, by the way, he didn't even invent that. It's just, that's a name people have heard of. He's copying programs that already existed in the United Kingdom, in New Zealand, in Australia, because math is math. The only thing that's a little bit different is banking regulations, in English speaking countries and stuff. So in the example we've been looking at, if we happen to send in $200.10 at the same time we sent in our minimum payment on the first payment that was due, because we're assuming we have a brand new mortgage here, we have 360 payments, right? That's what all these assumptions are. Based on those assumptions, $200.10 would knock out exactly $999. Because again, common sense, if you've already prepaid that principal, they can't charge you interest on what you already paid principal on. So different example, what if we sent in $1,010.54 on this exact schedule? That'd save us exactly this number right here, rounding off a little, sending in about 1,000 and save us about 5. So the key principle here, the takeaway is it's not just the 1,000 that we're prepaying. We're also eliminating interest on the back end that we would have paid. Okay. So here's the same example, but just with a bigger number. And I really don't know anyone who could put in 5,000 every single month. Right. And, for a lot of my clients, even to save up 5,000, it'd be a fairly big deal. But just to show you how much damage we could do if we sent in an extra 5,000 with our payment, that knocks out 23 payments.
Wow. So
if we were at 360, now we're done in 337. Like I was saying, when I first ran my numbers, I saw I could go from 17.5 years to 7.5 years. And that's saving me money too. So for me, that was saving me $109,000 because my income's gone up since then. I'm now on schedule to get paid off in about, from the time I got the program, maybe 3.5 years, because my income's gone up. Now that's
Okay.
not typical. I'm just talking about myself now. This
Yeah,
part's
yeah,
not
yeah.
typical of the program. Okay. But for me, because my income's gone up, my time to get out of debt's actually gone down, and the amount I can save has also gone up.
Okay. Makes
Okay.
sense.
So just really, really quickly, side note, and kind of on pause here, just like total footnote. You mentioned that you were pretty tight on money. Do you have any bandwidth, so to speak, to have any kind of a side hustle and maybe make a little extra money?
I wish that I did. I'm considering changing careers, but I'm not there yet.
Okay, well, I'm not talking about changing careers. I'm just talking about maybe a little add-on something. But if you love this program and you end up loving it, just know that you could make a little extra money here and there just by loving the program and not being shy about it. Okay, so
Oh,
just
gotcha. Okay. So
yeah,
referral.
yeah, enough said about that. Okay, so what we're really here to talk about is eliminating your debt and getting the bank's profitability reversed back into your purse. That's what we're fundamentally here to talk about. We
Mm-hmm.
could do that a little bit faster if we could also show you a way to make a little extra money here and there. So,
Bingo.
all right. So, moving on to open-ended credit lines here. The most common credit line that everybody has and is experienced with is credit cards. And hold on, I forgot to turn off my ringer. Bear with me one second. It's my buddy in Oregon who is trying to call me, and I didn't want to hear that ringer in the background. I apologize.
Thank you.
All right. So anyhow, what was I saying about credit cards, right? So with credit cards, they are an open-ended credit line. We talked earlier about a home equity line of credit. The other thing that works as an open-ended credit line is available liquid cash value in a permanent cash value life insurance policy. Okay. And so to give you an acronym, that has to be, it can't be any old insurance. So it can't be term insurance. It has to be life insurance. There has to be some cash in it, and the cash has to be available, right? So that would be a liquid asset safely earning returns. It also
Okay.
has to be completely safe, because it can't be a savings account equivalent if it's not completely safe and liquid and accessible, right?
Right.
So the acronym is LASER, a laser fund. That's a liquid asset safely earning returns. Now, whatever of those three that we talked about, and the most common one is the credit card. A lot of times people come to us and the line of credit that they do have is credit cards. And so usually we have to get those paid down first. Our initial goal would be get it down to 30% utilization to improve your credit. Now, this is another one of my little corny jokes, but it's also kind of dead serious. Warning, our program is not about credit repair, but caution, side effects may include improved credit. Okay.
No, that's cute. That's cute. Jump back for 20 seconds. Laser
Uh-huh.
again. Laser is liquid assets.
Safely earning returns.
Okay. Cool.
That's funny. It's the voice recording thing that's doing taking dictation.
Yeah.
Translated as liquid acid. Am I back in college? Wait, no, just kidding.
That's funny.
No, liquid assets is what we're talking about.
I got it this time. Whoosh.
That's pretty fun. So yeah, and that is the difference between the three types of open-ended credit lines we were talking about, is that two of them are debit based and the other one is an asset, actually, right? So capitalizing on that pun. But when you're dealing with an asset, then when you take money out of it, because it's an asset, you have collateral. And if you have collateral when you take a loan, it's fundamentally different than a normal loan, which is actually the next thing I wanted to talk about. Because when banks operate, they make money by borrowing money. So we've been in a Dave Ramsey seminar, okay? So we're going to switch gears right now. And I'm guessing you've probably heard of one of the following three things, if not all of them. They all mean the same thing. Be your own bank, infinite banking concept, bank on yourself.
Okay.
You might have heard those phrases. They all mean the same thing. They're what I'm talking about right now.
Mhm.
Banks take in all of our deposit by direct deposit, and technically they do pay us. Now, I don't know about you, but personally, I think it's kind of a joke that they pay us like 0.1%, and it's not funny. It's just like, but technically they do pay us, right?
Right.
And then they loan our money out to other people at much higher rates than that. But they're not done, because they're also going to borrow money from Uncle Sam. And that's at the prime interest rate, which is usually between 0 to 1% historically. And again, they turn around, and I'm not mad at the banks. I am mad at their amortization schedule, but
Yeah.
I'm
Yeah.
not mad at the bank. I want to be like the bank. And for about a year and a half now, I have been my own bank, because I have a liquid asset safely earning returns. And I can borrow on that against my own collateral. I can't take out more than I put in, just like a piggy bank. But it is a loan. So my money is untouched. So if I put in 20,000, and these are my real numbers, in the last year, I've put in 20,000, I've taken out 15, but I'm still earning interest on the whole 20, because they loaned me 15.
Wow.
And they loaned it to me at 3%. And
Wow.
over the last 18 years, this account has a track record of earning 7.26.
Wow.
So even if it did a little bit worse, like 6 or 5 or something, I'd still be making money on borrowing my own money. That's pretty cool,
Incredible.
right? So
Hmm.
that's the infinite banking concept. Usually that's attached to a whole life program where you'd be lucky to make 5 or 5.5%, but we're using something called indexed universal life. So that's kind of a whole nother webinar to get into that in a little more detail, but it is part of what we're talking about right here, because whatever debts we have and whatever assets we have, they all have different terms and conditions. So on a normal typical loan that's a recourse loan, it's what you typically think of when you borrow money. You have to apply for it. You could be turned down. If you make your payments late, it'll mess up your credit. And if for some reason things got really, really bad and you couldn't make the payments at all for long enough, they'd write the whole thing off. And to make it even worse, it would become a taxable event. And this part actually really kind of bothers me. It's the law, it's the way it is, but it really bothers me. But when people go completely belly up on debt, they also end up owing taxes on it. Did you know that?
No.
Pretty crazy, right? So, don't do that.
Wow.
um, but yeah, that's how it works. That's a normal loan. None of that can happen on the type of loan I was talking about a second ago, the type of loans I'm taking from my own account, because who's going to care? It's my money. I'm taking my money.
Yeah.
And my collateral, they have my collateral. So whether I have a recourse loan or a non-recourse loan, or to put that slightly kiddingly, the new one I'm telling you about, I like to call that not your daddy's loan, right? Okay. And what, as opposed to what we're used to. So where the technology comes in is based on the terms and conditions of these different accounts, whether they're recourse or non-recourse, and whatever the interest rate is and our balances. The technology, just like at the bank, when they're making decisions about when to move money into a sweeps account and loan money overnight to Zurich and Hong Kong, and when they're taking in our deposit and loaning it back out, they used to 100 years ago, they had guys sitting around in funny little hats under those funny lights doing ledger paper. But
Right.
nowadays they've got machine learning and artificial intelligence. And so do you. You've got it in your purse. You've got a phone in your purse. It's got GPS on it.
Right.
Assuming you drive, right? Almost everybody we talk to is already using a version of this technology. It's a mapping technology, except we're talking about financial GPS. And this financial GPS is not going to give us turn-by-turn directions to get to Walmart or Wendy's faster. It's going to show us how much money to move on what date, from which account to which account, based on those terms and conditions we've been talking about, to arrive at our debt-free date the fastest way possible. And that's where we want to get. That's where we want to be.
Yeah.
Okay. So in order to do that, as I kind of already indicated, we just need to know how much you owe, the interest rate, and then your payment amount. Now, the one thing that people usually have to look up is the escrow portion. I've met like 3 people in 2.5 years who knew their escrow portion off the top of their head. And they were freaks, believe me. Trust
They're freaks. Well, I just
And I mean that-
refinanced, so I
yeah,
probably
yeah,
know
and,
it.
and I mean that in a good way. And if you know it and you're a freak, then good for you, because that's a big thing. But there's a couple other people who are like, yeah, they know their driver's license number or stuff like that. I'm like, good for you, like I gotta go
Mhm.
look mine up. But anyway, Nicole, I believe, was helping you with some confirmations and stuff. So if this is looking like something that you want to see what your specific numbers would look like, and it sounds like you do, then I'm going to have Nicole contact you to go ahead and collect that information. And she'll also get us scheduled for another appointment. So does that
Okay.
sound like a plan?
Sounds good.
Perfect. So before we wrap up right now, I just wanted to show you a couple other things that I would be remiss if I didn't. So whatever those numbers are that you tell Nicole right now, they're going to change because you're human, right?
Right.
And like everybody else. I've been doing these interviews for a couple of years now, and I really haven't talked to anybody who disputed me on this point. Everybody's budget changes a little bit from week to week and month to month. It just does. So there's certain things that stay fairly stable, the trash bill, the water bill, internet, stuff like that, but a lot of other little things change. So this is the biggest difference between us and Dave Ramsey, other than cost. Because what Dave Ramsey in this program is famous for is having to pay a lot of extra for coaching. So one thing you should understand is that if you did end up feeling that this program was a good fit for you, then you would, at that point, you would pay for the program. So there's no cost for our next meeting. There's no obligation. And if you love your numbers and you like what you see, and in a typical case for a lot of people, we can save them something similar to mine. I actually find that my numbers I've been telling you are a little on the low side. A lot of people, we can do better than 10 years and 100,000. So if your numbers were anything in that range and you could get started for no money down and somewhere's around $100 a month, that'd be no big deal. Okay.
Okay.
And so what I'm saying is, for no additional cost, you also get me as your coach to help you get installed, set up with the program, organized, and then having about a month of organized follow-up where we're meeting for a much shorter period of time, but to make sure everything's going smoothly. And then I'll know that you're done when I show up for one of our coaching sessions and you've already done all your inputs and you're like, okay, coach, how did I do? I'm like, you good. And yeah, all right, cool. We're good. Right. So in order for the program to work, other than making sure we could save you enough time and money, and this is why I want Nicole to get your numbers ahead of time, because if we can't save you at least 50% on the interest that you would pay to the bank, then, we might not be able to help you. And
Yeah.
from what you've told me, there's a chance of that. That's why I want to, run your numbers ahead of time. There's no cost or obligation for that.
Okay.
But if we can save you some time and money, then we definitely ought to talk again. Okay.
Okay.
And so we do have to have one of these. And you already told me earlier that you had a credit card and a savings account. And then there's also the possibility of a hybrid account. So on this little graphic right here, this is kind of visualization of how the program works. So over here in our checking, we have direct deposit coming in. And this middle is labeled IUL LLC, like I've been talking about, but it could also just be a savings account. We could also, once we've paid them down, use any available balance on credit cards. And if we had or could get a home equity line of credit or any other type of line of credit, any of those things I showed on the last slide could be this middle, is what I'm saying. So you get paid and you tell the system what you paid for, both that was on the budget and the other stuff that wasn't supposed to be on the budget. And then the system tells you exactly how much money to move to the middle. Now, earlier when we were talking about sending money to the finance company, if we did that, obviously we wouldn't be able to get it back. But when what I just showed you, we haven't done that. We've moved it to something like our savings account.
Mm-hmm.
And we're going to keep doing that until it's safe, as I already alluded to go make that kill shot. Now, I'm pretty sure you've seen the Terminator movie, and yeah, who hasn't, right? By my unscientific survey, approximately 95% of Americans have seen the Terminator movie. And so in that movie, the Terminator's hunting and tracking until it gets locked on target, and then it goes and takes the kill shot. It's a perfect analogy to what we're talking about here, because all of this stuff we're hunting and tracking, and what we're waiting for is to be locked on target to make sure that Dion's emergency cash reserve is taken care of.
Yep.
And who's in control of that? Dion. Who's Dion's little assistant to help make sure it's programmed correctly? Coach Chris,
Okay.
right?
Mm-hmm.
Have we accounted for Dion's retirement savings goals? For any other goals that you have, that maybe you want to travel, maybe you want to start up a business, well, whatever goals you might have, you communicate those to me and I will help you program them into your system. And then the system's going to know that. And because it's machine learning, just like when you type or text and it starts to learn your words and your word patterns, this will learn your spending patterns and habits.
Okay.
Okay. And so over time, as long as you're honest with the system, it's going to literally, like, you're always in control of it. It works for you, but it's going to get to know you like a personal assistant. So between me and the technology working together, you've got the machine learning expertise and then my help with it to make sure that your goals are being accounted for before we send any money to the finance company, which eventually we're going to need to do if we're going to get you out of debt faster, right?
Yep.
Okay. So to put the baby to bed, I'm going to hop over here to my personal account. And let's see if I'm still logged in here, just shadow logged in. Come on, technology. There we go. It looks like I'm still logged in. So sometimes I'm not if I could log out here, but this is a web-based technology. It's not a software, doesn't take up any space on my computer. I can get to it on any device where I have internet access anywhere in the world. Okay.
Okay.
The other thing I want to emphasize is, even though it says right there, it says account, you can read it, it says right there, this is not an account. It makes me a little nuts. I love this company. I love this product. The one thing I wish they would change is it should be called the Money Max system or program or anything but account, because it's not an account. Your
Okay.
checking account's an account, your bank account, your savings account's an account, any cash value life insurance you might have, any investment accounts, your mortgage statement, those are all accounts. This
Okay.
is a record keeping system that keeps track of all that stuff and advises you what to do with all those things. But then you have to go and do it. Okay. Now, once we've gotten through the first month, and if everything's gelled and you're feeling good about it, then we do recommend an automation. There is an extra cost for that. It's pretty nominal. It's like $14 a month, but we really do recommend that, especially for busy people. You don't have to do it that way, but if you can afford it, we recommend the automation system. But we don't like to start with the automation because we want you to start to look at and learn your own burn rate of money and start to be accountable to yourself.
That's so funny because that was a goal I set today.
Really?
Yeah.
Okay. Well, so the system in the first place would help you to, it really does three things, big picture overview. Number one, it's a lot like something like Quicken to help you just get organized and see all your stuff in one place and all that kind of good stuff. Number two, as I've fundamentally been talking about mostly, it's a debt shredding tool to help you eliminate your debt by canceling interest, as hopefully I taught you by now.
Yep.
And then the third thing, as I'm about to show you, is it can also be used to forecast anything we want to do in the future. So like it's showing right here that I have 1.6 million of debt, but 1.4 million of that is future debt I want to go get
Oh, cool.
that I
Okay.
don't currently have, but I've
Okay.
already put it into my system so that the system knows that, and it's taking that into account because it knows my time frame about when I want to do that and everything. So with all of that in mind, in that last graphic I just showed you, you can see at a glance these red and blue squiggly lines.
Yep.
And it's telling me exactly how much money to the penny to move over to my savings account. And you can see that it wants me to do that in my case for a little while. So since I'm in commission sales, my income varies a lot. Sometimes I make a lot more than I put on the thing here. Sometimes I don't make anything.
Okay.
Depends, right?
Yeah.
It's just life of sales. I'm used to it. It's been a couple decades, right? But on or around this date, the system is going to want me to send in about this much money. Now, I could be using a normal savings account. And let's just assume that I was for the moment. I would write a check for this 62,600, and that would cancel, in my case, based on my numbers, right about $45,000 of interest. Woo!
Yeah.
Have a pizza party, right? Invite some friends over. Well, maybe with coronavirus, we'll do it virtually. Another one of my attempts at humor. But I would be writing a check that would be gone. Okay.
Okay.
Now, I already told you I can take a loan instead. Doesn't that sound better than writing a check?
Maybe. Keep going.
Well, remember a minute ago, I told you how I've already put 20,000 in
And
that.
I'm going to make money off of the loan that I'm pulling.
Right.
Okay. Okay.
Right. So this is just to make it clear, I was putting it as a regular savings account, but this is my super save. This is that one I was telling you about.
Okay.
So this is the one that's been making 7.26 over the last 8 years. In the last 10 years, it's made 8.15.
Okay.
I like to be conservative in my own mind and assume it'll maybe make 5 or 6. But when I borrow that money at 3% and I'm making 5 or 6, whatever the net is on that, let's assume it's 4%. 7 minus 3. At 4%, this 62,000 in 18 years, I'll be able to spend that same money again because
Wow.
of math. Let me roll that back just a little bit. If
Okay.
you take any interest rate, you name it, 6%, divide that into 72. Easy math, that's 12. Well, what if we got 12% interest rate? Well, first of all, nobody gets 12% year over year. Nobody.
No.
Nobody. Ask Warren Buffett or any other legendary investor. But just for the sake of discussion, at 12%, we could double our money in 6 years. A realistic amount that there's a track record of getting is 7%. That's what I've been talking about. At 7%, we could double our money in 10 years. But if we're taking it in the manner I've been describing, there is a cost for the loan. It's 3%. So it's more like 4. Still easy math. 4 goes into 72 18 times.
Amazing.
Assuming somewhere around 4% in 18 years, I'll be able to spend this $62,000 again. I'm 52 years old. I'll be 70 by then.
Okay.
Be pretty handy to help me pay for a few extra things down the road for retirement.
Yeah. Yeah.
Why not partially pay for my retirement by paying off my debts while I'm getting out of debt earlier and canceling the bank's profitability?
Amazing.
My work here is done. I'm going to text Nicole and help her and tell her to go ahead and call you to get your intake numbers, and she'll get us scheduled for another appointment. I'd love to do that just as soon as possible. I do have some availability in the next 48 hours. Nicole has my schedule and availability. So doesn't sound like you have any questions. So I'm going to go ahead and end the meeting and the recording. And Nicole's going to give you a call. She should be standing by and ready to do that.
Okay. Thank you.
Okay. Nice to meet you, Dion.
Nice
Talk
to meet
real
you
soon.
too. Take care.
Okay.
Bye.
Yes. Talk to you soon. Bye-bye.